give him time to get set up. So Ben, I'll let you speak up and say what you want to do.
Can you hear me?
Yep.
Okay. I'm ready. If you want me to go now, or I don't know that we need to break this early, but I'm ready to go if you want me to dive in.
Let's plan on just going. So
Okay.
Ben has quickly become one of my favorite people in the world. So him and my daughter have played tennis together.
My daughter and your daughter, not
yeah.
me and your daughter.
Yeah. Well,
Makes me sound creepy.
Yeah. It's my mind's already shot apparently. So thank you for that fix. As I completely undercut your introduction. But he's awesome. He's a financial advisor in town. He's really, really wicked smart with numbers and economic data. So with that, Ben, don't disappoint. No pressure.
Sounds good. Thank you. I just want to say that I appreciate the opportunity to present to all of you. I have really enjoyed getting to know Derek, and he's a great guy. I still don't know him super well because I'm new to town. We've been here for almost 3 years. Next year it'll be 3 years. I'm from Brigham City, and was kind of like a Brigham City Uncle Rico, but my wife started having some breathing problems, and I researched clean air and found Cedar City, and we have moved, and that was hard and challenging, but we love it here. We absolutely love it here and really enjoy the community, and super happy to be here. So, but one of the things I like about Derek, and I do want to just kind of start off as well, he said some nice things about me, but he is extremely passionate about what he does, and he puts his heart and soul into his business. He really cares about his owners and vendors and his tenants too. And it's very generous. And I know I know 3 or 4 circumstances where he has used his own money to be able to help other people in the community. And of course, like I said, he's also hilarious. He makes me laugh a lot and says stuff that you're not expecting. And I love it. I appreciate that. And it's a pleasure to be able to help him. So thank you very much. As he mentioned, I do like to nerd out on data, but I don't want to put you guys to sleep also. So anyhow, I put my thoughts together from the standpoint of what I thought would be important for you as business owners and real estate owners to know about the economy in general. But I'm trying to look a little bit through your lens as real estate owners. I'm going to share my screen. I'm going to go through a bunch of slides along the way here. Just a second here. Let me find the right one. Okay. Zoom over here and okay. I love this quote, and I often use this quote when I'm talking with somebody about if they come in and they have investments at another place, and they're not diversified the way they should be. But the quote from William Arthur Ward is, "The pessimist complains about the wind, the optimist expects it to change, and the realist adjusts the sails." And the reason why I want to share this with you is, in general, in my life, I am an optimist. But when it comes to looking at the economy, stock market, bond market in general, I feel like it's my responsibility to look at this as a realist, right? And if there's, storms on the horizon, then, I need to be aware of those. And a lot of times financial advisors tend to be optimists. You have to kind of believe in the future for this career to work to a certain extent. But but I think that you need to look at it as a realist. And I didn't want to pick, there's a bunch of slides online that show this quote with smooth sailing seas. Okay. I wanted to find one that had some choppiness because the stock market is not smooth sailing. And the thought of being on this ship right here with all of these waves scares me to death. Okay. This would be a nightmare for me to be stuck on a, on a boat in the ocean with high seas, and so I did want to just share this to say sometimes when you are looking out, speaking of like rough seas and also weather, sometimes when you're looking out economically, things look smooth and the seas are calm and you can kind of see where you're headed. And sometimes it's pretty foggy, right? And right now is one of those circumstances where overall, I would say that I am definitely optimistic and cautiously optimistic, but it's not the smoothest of seas right now. So we'll talk about that. I just wanted to give you an update on what I want to discuss as far as my agenda. We'll talk about a brief review of 2023. We'll look at current economic data today. We'll talk about our outlook for 2024. And then I really hope that there's some Q&A because I don't know if I'm going to be able to take up all my time, and that's fine. We can have a break, but I'm hoping that there'll be some Q&A there. So I'm going to start here with a couple of pieces of data. The S&P 500, I like to talk about the S&P 500. I know Derek from a networking group, and whenever I presented to that networking group, I used to always like to do trivia. And so I'll do a little bit of trivia here with you guys. And I don't know if you want to unmute or want to ask these questions, or if you want to just put something in the chat. But the first question I have for you is how many companies are in the Dow Jones Industrial? Does anybody know? You guys there? Anybody know how many companies are in the Dow Jones Industrial? You guys hear me? Is everybody there?
Hush falls over the crowd.
Okay, well, it's 30. Okay, how many companies are in the S&P 500? Anybody? Derek, you know this, you can answer. All right, looks like we've got a chat here. 500. You're absolutely right, Mark. Thanks. So, and I like to do that trivia. And there are 500 companies in the S&P 500. When quoting performance of the stock market in general, I like to quote the S&P 500 because the S&P 500 is comprised of the top 500 largest companies in the United States. Okay, and so it's a better representation of what's happening than what's happening with the Dow. And we have a tendency to look at the Dow because it's a bigger number, but we really should be looking at the S&P 500. So the S&P 500 last year was up 26.85%. In 2022, that was down 19.5%. And beginning of last year, the stock market did really well. It took off pretty good from the start, did well through June. Then it got beat up really bad from August to October. I know just for August and September, the market was down 7%. And then, we got beat up again in October. But then we finished really strong in November and December. And so it's kind of crazy to think that the market was up 26%. I didn't expect that to happen. The bond market, let's see, we got one other chat here. Let's see if I'm, okay. And so Kyla says she hasn't bought into the stock market, and that's okay. I'm still hoping that you get something out of my presentation today. We're just going to talk about the economy in general. But the bond market was up 5.39%. The crazy thing about 2022 is that both the stock market and the bond market were negative. So I'm going to stop sharing here. I'm going to pull up a different chart that I want to share with you. And we'll talk about this a little bit. I just use my notes. That would be good. Here. Right, let me pull this back up. Okay, so I want to share, can everybody see the screen, hopefully? Okay. When we take a look at this chart right here, this kind of shows what stocks did from 1992 till last year. This is updated as of like the 12/12, okay? And then we show what bonds did as well. But what's crazy is there's only 2 years here where stocks and bonds were negative. It was 1994, and they raised rates a bunch in 1994, 1994 and last year. And to put this in perspective about how bad, sorry, 2022, to put in perspective how bad the bond market struggled in 2022, the worst year for bonds in the last 50 years would have been a negative 3% rate of return in 1994, and last year we were down 13. Okay, so it was significantly worse than the worst year that we've ever had in bonds. So as we look at what happened in 2023, at the beginning of the year, I thought the stock market was going to do okay, but not do great. And I thought the bond market was going to do really well. And the reason for that is I thought the Federal Reserve was going to start lowering interest rates eventually. If you think about it, we thought in the spring of last year, there was a whole bunch of talk about us having a recession. And people said there was like 80% chance of recession in like the third or fourth quarter of last year. And it didn't happen. And the stock market just ended really, really well. Bond market really kind of struggled, but that's because interest rates were up higher than expected, because inflation was higher than expected through the summer. And then of course they kept talking about, are they going to lower interest rates? And in December, they finally kind of clarified and said, we're done raising interest rates. And we think that we're going to lower interest rates by 75 basis points next year. So time will tell. And I'll talk a little bit more about that in just a minute. So I want to talk a little bit about the current state of the US economy right now. And the stock market, when we take a look at where it's at with how well it did last year, I feel like the stock market is slightly overpriced. I think it's higher than it should be. We kind of went gangbusters there. And let me actually show this. Go to page 5 here. And I wanted to show you down here. This is earnings estimates for the S&P 500 and go through some of this stuff with you. And when we look at the stock market, whether or not it's overvalued or undervalued, we look at this PE ratio, and that's price divided by earnings. So The way I like to explain price divided by earnings is to say, let's say that you wanted to buy Coca-Cola stock. Okay, your favorite drink is Diet Coke, and you want to profit on your beverage of choice. Okay, so you want to buy Coca-Cola stock. So PE ratio will basically kind of explain whether or not that stock is going to be overvalued or undervalued. So a higher PE ratio means stocks are more expensive. A lower PE ratio means that stocks are a little bit less expensive. Okay. So in an ideal world, what you would want, because we want to, probably the main thing we want to do in investing is you want to buy low and sell high, right? In an ideal world, that's what we want to do. And PE ratio will tell us whether or not you're buying low or selling high. So in an ideal world, you want prices low and you want the earnings of Coca-Cola to be high. Okay. And so if that's the case, that number will be low. Well, the 30-year average PE ratio of the stock market, the S&P 500, each company has to report their earnings. Publicly traded companies have to report their earnings. And that's where we come up with these numbers over here. But they basically say, this is what our earnings are. And, some nerds basically take and compile all that data for the top 500 companies and say, this is where the current PE ratio is. So as of, let's say the end of September here, the PE ratio of the market was 20.9 times earnings. Well, the 30-year average PE ratio is 16.8 times earnings. And right now, if we end at 20.8, then that looks like the stock market is priced high, based relative to earnings. So the forward PE ratio of the market right now from JP Morgan is currently 19.45%. And so that means that the stock market is potentially 15 to 16% overvalued. Okay. I told you the 30-year average PE ratio was 16.8. What's kind of interesting about us being, let's say, close to 21 is this. In 2020, the PE ratio at the beginning of that year was 21 to 22. In 2021, it was 21 to 22. In 2022, it was 21. Okay. And in 2023, last year, the PE ratio was clear down around 16. So, and it was actually below that average. So stocks looked a little bit cheap last year, and they should, because we came off of a year when the market was down, 19.5%, right? And it's been kind of interesting as I watch those trends of that PE ratio. When it drops below, that's when people start buying. They try and buy companies on the cheap relative to their earnings. And so the stock market does look a little bit overvalued right now. But we're going to now go take a look at the E in PE. So we're going to look at page 7 here. And, oh, wrong one. Okay, on page 7, I want to just show you that's the wrong chart. Sorry, just a second. Where was that chart? Maybe it's on page 5. What did I do with that chart? Let's see. This is a GDP outlook. I thought I was looking at an earnings estimate. Anyhow, sorry. I've got a chart here somewhere that basically shows the expectation for earnings. And earnings are expected to go up by, depending on who you talk to, 8 to 11% this year. And why that's important is that it's okay for the stock market. Here it is right here. Sorry. So this is on page 6. I just had the wrong page in my notes. This is the forecast for earnings. So it's okay for the stock market to be going up if earnings are going up, okay? And our forecast is 8 to 10%. Some companies are saying 11. I did hear from somebody saying that when you're coming off a really good year and the forecast for the next year is, let's say, high or good, you're typically not going to get as good of earnings as they are projecting. So I'm thinking earnings might be a little bit lower than that, maybe closer to that 8% end instead of the 10 or 11% in earnings. And we'll have to see. But the important thing here is that the expectation is that earnings are to go up. I want to, while we're here, and it's kind of not on the same subject, but in talking about the S&P 500, this orange chart here shows what the S&P 500 did since 1985. My wife just sent me a funny text about 2 weeks ago that basically showed a chart just like this. And it said, don't be stupid, right? And what she meant by don't be stupid is a lot of times people get scared by the headlines and they sell out. And a lot of times it's people that are really politically motivated, and they'll sell out because of political situations, and then they miss out on huge returns. And I had a client that did that in the spring of last year. You know, he was worried about political stuff, sold everything, sat there in cash and did nothing. I tried to get him put into a money market that was paying 5%, and he wouldn't. So he missed. He basically was earning, 0.3% while he could have been earning 5%. But if he would have stayed in the market, he would have earned 15 or 17 if being diversified, right? So just don't be stupid, right? The stock market's going to go up over time. There are times when it pulls back, but 100% of the time when the stock market has pulled back, we've gone on to set new highs, right? And so I think that's important. So, all right, now I'm going to talk to you about a summary of what our thoughts are. And I like to use JP Morgan's data a lot, but I tried to approve that through my compliance department and they said I couldn't. So I'm going to just show you what I have here from our kind of base scenario. So we expect in 2024 GDP, gross domestic product, that's all of the goods and the services the United States produces. We're expecting 1.5% growth there. Global economy is looking like it's going to grow somewhere around 3%. We think unemployment's probably going to go up. I've seen a different, I don't know that this is the right forecast. I think unemployment right at the end of last quarter was something like 3.7% or something like that. I do think unemployment will go up a little bit with interest rates being high and less jobs available and that sort of thing. We do think inflation is going to drop by 2%. The Federal Reserve has a target of a 2% inflation is kind of where they want to be. We think we'll get there by mid-year. The Fed funds rate, we're thinking will drop from the current rate right now, which is 5.5. We think it'll drop to 4.5 to 4.75. So they basically are saying straight from the horse's mouth, they're saying that they think that they're going to drop rates by 0.75% next year, and 10-year Treasury yield now near 3.5%. And this is where we said corporate earnings between 8 and 10% versus last year. This part I think is really, really interesting. And a lot of times as we head into election years, especially as divided as our country is right now, and with the two main candidates, a lot of people not necessarily happy about those. Some people are ecstatic, whatever. I'm not supposed to talk about politics or religion, okay? But what I am going to say is that, even though stock market volatility can be a little bit higher heading into an election years are pretty much almost always good for the stock market. So this is crazy, but heading into this election, the S&P 500 has never declined in a re-election year since 1952. And not to say that that won't happen this year. At some point, it is going to happen. But the stock market is typically good during election years. And that's whether that changes, whether whether the incumbent wins or not, the stock market typically does well. A lot of times that performance in the stock market is not going to happen until after the election has happened and we know what to expect as far as who wins that election. But it's just kind of crazy that the stock market is almost always positive in election years. There's another a little bit cheesy phrase to pay attention to, and that phrase is that as goes January, so goes the rest of the year. And so far for this year, if we look at the S&P 500, it is down 0.17%. So it's flat. But if you think about the beginning of last year, we started off really good and then we ended good, right? The year before that, we started off not so good and definitely ended not so good, right? So it's not always 100% the case, and we'll see what happens with the rest of January. But I think ultimately I think the market is going to be somewhat, and it's kind of weird. My forecast for this year is kind of my same forecast for last year, and I was off pretty good. But my thought last year was I thought that the stock market was going to be up somewhere between 5 and 10%, and the bond market was going to have a good year. Bond market had an okay year. I mean, a great year, actually up 5% for bonds. That's good. Stock market did way better than 10% though, right? So we'll have to see. But when we talked about those earnings expectations here for the next couple of years, in addition to this, we're expecting those earnings to go up. And in fact, if we come back to this page here and look at these S&P 500 earnings estimates right here, look at what the projected PE ratio is here towards the end of next year. So we actually think that the only way the PE ratios come down is there's one of two ways PE ratios come down. Either the stock market drops or earnings go up. And we do think earnings are going to go up. So from 2010 to 2020, stock market did amazing. And the reason why that was okay is because earnings went up significantly over that time period. Okay. Couple other things that I think are important. I am going to go to this page. I think I've seen this a couple times. It's on both of them. Let's go over here. Let's take a look. Oh yeah, the other one I want, it's over here. I did want to show you that rent one later when we get to real estate. Sorry, let me just find this. This is one of the charts I wanted to show you. And I think this is important. If you owned a property, I think this is an important thing to know because you want people to pay their rent, right? So consumer debt burdens are still pretty low by historical norms. So of course, interest rates have gone up. We know that, right? So it's more expensive to purchase a property. And because of that, that's probably why the inventory is high, is because it's too expensive and I've seen prices come down in Cedar, and I've seen inventories come up a little bit because it's just expensive and people are kind of fine with their situation. But if we take a look at consumer debt is a lower percentage of overall income from where we've been historically. Like that peaked right before the bottom fell out in the Great Recession in 2009. But overall, and it has become more expensive with interest rates going up. But as a percentage of overall income, those numbers are still pretty low. I don't have a chart on this, but well, let's talk about unemployment a little bit. Unemployment we talked about in that forecast. Our forecast, I think, unemployment to be somewhere around 4, maybe 4 to 5%. 4% unemployment is what we would call like full employment, where basically if you want a job in America, you can get one, right? And So the other thing that's really important about people having jobs and the unemployment rate being low is that 70% of our economy is driven by consumer spending. So I'm going to stop sharing here for a second. So 70% of our economy is driven by consumer spending. And so if people have jobs, they spend money. That's like it's like a US obligation to spend all the money we have and maybe even more. So consumer's pretty strong, and credit card debt has spiked a little bit too, but it's still, as far as a percentage of overall income, is fairly tame. I'm just going to share a couple of other thoughts, some statistics. Consumer sentiment has improved. Like at the end of like June of last year, consumer sentiment was really, really low. Okay. And whenever consumer sentiment is low, it's a great time to buy. Okay. So since then, the market's done quite well. When consumer sentiment is low, for the next 9 months after we hit a trough or a low part in that, the stock market averages 24% over a 9-month time period. So it's done pretty well. Another thing that I think is really, really important, just a couple bullet points here as I get close to wrapping up here, is that the stock market is positive a lot more than it's negative. So if you go back to 1980, so we're looking at a 43-year time period, the stock market has actually been up 75% of the time. So 3 out of every 4 years, the market is positive. So I like to say 3 years up, 1 year down, 3 years up, 1 year down, right? And I think that's important. And I also like to tell people, but the market does drop every year, right? And a 10% pullback is called a correction, and that happens on average once per year. Okay. And in fact, the average that it pulls back is 14.4%. And you might say, well, if the market pulls back 14% every year, why should I invest? And the reason why is because it recovers. And 76% of the time, it is positive, right? So that 10% correction happens annually. A 20% drop is a bear market, and that happens about 1 in every 4 years on average. So that's a little bit more rare. We went a long time without having a 20% pullback, but we did have one. I like to say, when you think about those expansions and the pullbacks or recessions, that the average expansion is 48 months, about 4 years. The average recession is 14 months. So think of that as long summers and short winters, right? So the market goes up more than it goes down, and it's for longer time periods. Okay. Another thing that we touched on a little bit was recessions. And I think the most likely scenario is that we have a soft landing. We could have a recession this year. If we do, we think it'll be a mild one. And there's 2 definitions of a recession. The first one is 2 negative quarters of GDP growth. Well, we're forecasting that we don't have negative GDP growth. So we think the economy may continue to slow, but we're going to avoid that recession. And so if we avoid the recession, that will basically be what we call a soft landing, and that's what we're hoping for. Okay, and that's what we had last year. We were expecting a recession. Maybe a lot of people were expecting that recession at the end of the year, and it just didn't happen. So I want to talk to you about bonds. If you remember, I showed you that chart that showed that stocks and bonds are very regular, or very rarely down in tandem. Okay, and bonds are really quite boring. So let me actually share a screen with you here. We're going to look at page 9 on this report. If I can find it. Okay, so on page 9 here, for bonds, I wanted to show a little bit of a trend here. And this is basically showing what happens when interest rates go down. So for bonds, when interest rates go down, bond prices go up. So I'm more excited about bonds right now than maybe I've been in my whole career. And here's why. And I wanted to share this with you, but I couldn't get it approved from my compliance department. But there's a chart that basically shows that when interest rates peak, which is where we're at, the Federal Reserve has said they're probably going to lower interest rates next year. When interest rates peak, then bonds do well for the next couple of years. The 1-year return for bonds when interest rates peak is an average of 12%. The 3-year average and 5-year average for bonds is an average rate of return of 8% per year. And of course, that's no guarantee, right? But typically when interest rates go down, bond prices go up. So this kind of shows that when and the longer the maturity, the more fluctuation you're going to have, right? So if interest rates go down by 1% in 10-year treasuries, you can actually see approximately a 12% rate of return when interest rates go down. So we know interest rates are going to go down, right? Now, in anticipation of that, bonds have actually come up in value for the last couple of months, but they have a long way to go. So this last summer, I was talking to a representative from a mutual fund company, and he said, a year ago in this core bond fund, this kind of plain vanilla boring bond fund, a year ago, our bonds were yielding 1.5%, and they were priced at 99 cents on the dollar. Now, when bonds mature, they mature at $1, okay? And he said, now interest rates on these bonds are at 4.5%, and they're priced at 92 cents on the dollar. Okay, so if you just do the math on that, bonds when they mature, if they're going to mature at $1, then you're going to make 8% by going from 92. It's actually a little bit more than that, but if you're going to go from 92 to 10 to 100 is 8%. So you're going to be getting that type of increase in the value of those bonds as they work towards maturity. But you are also going to, the yields have gone up quite a bit. So the yields are now in the 4 to 5% range, which is good considering they were at 1.5%. So bonds, if you look historically over the last 10 years, have done terrible. But I think they're going to do really well over the next couple months. So I think it's a good opportunity to look at bonds. I also really like tax-free bonds right now, municipal bonds. So if like Iron County needed to redo the sewer and they didn't have $100 million to do it, they would do a bond, of course. And if it's a municipal bond, if it's a bond that's issued by a municipality, then there are no taxes on the interest that you receive there. So my favorite high yield bond fund, tax-free bond fund right now is yielding over 5%, but that's federally tax-free. You have to pay some state tax on that, but 5% tax-free, you'd have to get, depending on your tax bracket, 7 to 8% to be able to offset that in a CD or a taxable bond. So bonds look good, and I think they look attractive, really, really attractive. I'll wrap up here. I also looked at a couple different things as far as real estate is concerned. And again, this was on a JP Morgan chart. There's a really cool chart if you want to nerd out on overall US economy called JP Morgan's Guide to the Markets. It's about 60 plus pages that's updated on a quarterly basis. And I really, really like it, but there's a lot of data there. And I found in looking at their charts on real estate, nationwide inventories are still fairly low. Single family housing starts are at pretty close to where they've been over a long-term average time period. Rental vacancy rates are lower at an average of 6.3%. And since 1956, that average has been 7.3%. Multifamily, this is really interesting on multifamily housing starts. So when we're looking at apartment complexes for student housing, for example, or larger apartment complexes in different metropolitan areas. Multifamily housing starts in 22 and 23, the first part of 23, went up quite a bit. So a lot of buildings were built, and Those have really dropped, though. They've come down quite a bit. I think part of that has to do with interest rates being high. The other thing about that, my office before I moved down here was in Ogden, Utah, and I went back there a month ago, and I could not believe how many large apartment buildings have been built in the last 2 years. Right close to the Walmart in downtown Ogden, there were like 12 massive buildings for housing. So I know I remember seeing a study 3 or 4 years ago, probably 4 years ago, that said that Utah was 55,000 housing units shy of demand. And I think in those cities, we've just seen those large apartment complexes just pop up everywhere. And of course, now there's a lot more supply. And when you have more supply and less demand, the prices come down, right? Housing affordability is still low, so it's expensive, obviously, to buy because interest rates are high. That'll be nice when interest rates come down. It'll be less expensive to borrow, and that will mean that there's more economic activity. And then I'm just gonna wrap up here. I guess I would just say, does anybody have any questions for me at this point? I think I'm supposed to be done at 11:20. Any questions I can answer?
You made them that much smarter, Ben. They don't have any questions.
Okay, I want to just say just a couple other things. For any of you that may own real estate that maybe wants to get out of traditional real estate but doesn't want to pay taxes, I've got a diversified REIT that's averaged, I don't know, somewhere about 7% or something like that over the last 10 years. And you can actually 1035 out of a property. Sorry, 1035 is an insurance term. That's what I'm usually discussing. You can 1031 out of an opportunity there into, 1031 out of an existing property, into one of these REITs, if you wanted to transition out of some of your physical property without having to pay the taxes and to defer those taxes. And so they have a program that allows you to do that. It's a really big company that we work with that I can help with. And last couple of things I'm going to say, and that is that recently we received the award of Best of Iron County for Financial Planner, which is exciting. I do custom recommendations for my clients where I kind of call it the all-star team approach, where I want my clients to have the best investments in each category to make sure they're appropriately diversified. As providing service, I meet with my clients every 6 months to make sure that their portfolios are on track, doing what they're supposed to be doing. I love doing a free review. So if you're unhappy with your financial advisor or feel like you're paying too much, I'd love to see a statement. I can usually almost always reduce costs and improve performance. And with that being said, the last thing I'm going to say is that Mitchell Smith was also in my networking group, and he is a great guy, and I'm excited that we get to hear from him next. If any of you do have any questions, if you just type in Ben Huff, Ameriprise Financial, then you can find my contact information in Google. I'm the only Ameriprise advisor here in Cedar City, independent financial advisor, and love to answer any questions they may have. But again, Derek, appreciate the opportunity. Thanks for your time, and please reach out to me if you have any questions.